Welcome to this explainer. Today, we're diving into an absolutely massive shift happening in the global financial landscape. We're going to track the wild evolution of digital assets. We're talking about a journey from being literal, life-saving necessities for folks on the ground straight up to the corporate boardrooms where they are totally rewiring global institutional finance. If you've been trying to make sense of this whole transition, well, you're definitely going to want to stick around for this.
Okay, let's dive into this. So take a look at this famous quote from the late financial titan Charlie Munger. He literally called the development of digital assets disgusting and contrary to the interests of civilization. Ouch, right? It's a sentiment you hear all the time from financial elites. But we really have to ask, whose civilization are we actually talking about here? Mainstream Western coverage focuses so much on market speculation and all the regulatory headaches, but frankly, that kind of dismissive perspective completely misses a very stark global reality.
Just look at this data derived from Alex Gladstein's Check Your Financial Privilege. It is genuinely eye-opening. See that tiny 13% slice? That represents everyone lucky enough to be born into a privileged fiat currency like the US dollar, the euro, or the British pound. The massive 87%? That is the rest of the world. To put that into perspective, we're talking about 4.3 billion people living under authoritarianism and another 1.2 billion facing extreme double, sometimes triple-digit inflation. Look, when your money works just fine, it's pretty easy to dismiss alternatives. But for the vast majority of people on this planet, the legacy financial system isn't a safe haven at all. It's actually a massive vulnerability.
Which brings us to part one, the grassroots lifeline in repressive regimes.
To truly grasp what digital assets represent today, we really need to shift our narrative down to the hyperlocal level. Let's take Nigeria, for example. Operating against a really challenging macroeconomic backdrop of roughly 15% annual inflation, an entrepreneur named Ira Aderonokan watched her local currency literally just bleed purchasing power day after day. She realized Bitcoin could actually serve as a vital store of value. But she didn't just buy it and sit on it. She actually co-founded an app called Zencash, which uses the Bitcoin network for everyday cross-border payments. The real ultimate test of this infrastructure, though, well, that came when human rights activism entered the picture.
So, picture this. During nationwide protests against a notorious police unit known as SARS, a group called the Feminist Coalition was actively raising funds through standard, traditional fintech channels. But suddenly the regime cracked down hard, and their bank accounts were totally shuttered. Boom, cut off entirely from the financial system. But they pivoted. They went ahead and set up an open-source BTC Pay server. This was crucial because it protected donor privacy and prevented address reuse, and through this, they safely raised over 7 Bitcoin. When the traditional system was literally weaponized against them, this decentralized network wasn't just a tech experiment, it was their absolute only remaining lifeline.
And this brilliantly illustrates that Nigeria is far, far from an isolated case. In Afghanistan, digital assets provide a desperate refuge from total economic collapse. Over in Cuba, they offer a real escape hatch from state-led monetary repression. And in Palestine, people are using them to build a resistance economy. Across all of these incredibly different regions, the core value proposition is exactly the same. It's about permissionless, borderless survival.
All right, shifting gears a bit. Let's look at part two, crossing the reversibility point.
Now, I want you to hold those stories of grassroots survival in your mind for a second, because we are looking at a truly fascinating paradox. The exact same technology powering human rights activists is simultaneously taking over traditional finance. Just look at this really stark thesis from the 2026 PwC Global Crypto Regulation Report. It says institutional involvement has crossed the point of reversibility. Think about that. Banks and massive payment providers aren't just, playing around in the sandbox anymore. They are fully committing, actively embedding digital assets directly into their core infrastructures and their balance sheets.
What's kind of mind-blowing is the dual reality this creates. In wealthy markets like the US and the UAE, the focus is almost purely institutional. Stuff like tokenizing bank deposits or building fancy capital market infrastructure. But at the exact same time, in regions like Afghanistan and Nigeria, the primary use case remains basic: day-to-day survival, remittances, and hedging against inflation. Guys, it is literally the exact same underlying technology, but it's solving vastly different problems based entirely on your local economic privilege.
So you're probably wondering what suddenly gave traditional finance the confidence to make this massive leap. In a word, regulation. It's no longer just a constraint or a roadblock, it's actively reshaping these markets. The whole crypto stack is professionalizing right before our eyes, fragmenting into highly specialized infrastructure for custody, compliance, and settlement. And that newfound regulatory clarity, that was exactly the green light these massive institutions were waiting for, so they could finally scale responsibly.
Which naturally brings us to Part 3, regulating the digital future.
Now, what's really interesting about this slide is how the narrative actually comes full circle. We literally just talked about Nigeria heavily relying on crypto at the grassroots level to protest the state and simply survive. Yet simultaneously, the Nigerian state itself is leading the charge in global institutional regulation. This architecture for Nigeria's newly integrated digital markets regime, it's honestly a masterclass in watching a jurisdiction shift from total, outright prohibition directly into structured institutional supervision.
The legislative turnaround here is absolutely staggering. I mean, back in 2021, their central bank outright prohibited banks from even touching crypto. No way, no how. Fast forward, and the Investments and Securities Act of 2025 formally recognizes digital assets as legitimate securities and commodities. The central bank now actually permits designated bank accounts for licensed service providers. And here's the real kicker. This robust framework paved the way for Nigeria's 2025 removal from the FATF Gray List, which is essentially the global financial watchdog's naughty list. They basically transitioned a vibrant, underground shadow economy into a fully structured, globally compliant financial system.
Now, zooming back out to the global macro scale for a second, there is one number that kind of tells the whole story. 95%. That is the percentage of global stablecoin value that is denominated in US dollars. For populations out there facing brutal currency volatility in emerging markets, stablecoins essentially act as de facto digital dollar accounts, and they do it without anyone needing a traditional US bank account. It's wild because it's expanding the dollar's global reach through decentralized technology rather than, state policy. It's effectively bridging the unbanked in the global south directly to traditional financial architecture.
All of this leaves us with a really critical, unanswered question. We've seen how digital assets act as a literal lifeline for individuals fleeing oppressive regimes, but we've also seen the biggest financial institutions and powerful governments racing to capture and regulate that exact same infrastructure. So, as digital dollars bypass traditional banking to become the new global standard, who will ultimately govern the future of money? Is it going to be decentralized networks prioritizing human freedom, or traditional institutions prioritizing control? Thank you so much for joining me for this explainer, and I highly encourage you to keep exploring these sources to dig deeper into that very question.